Hey, hi everyone, welcome to today's podcast. Today we'll look at an investment thesis for Indofarm Equipment Limited, which is a small cap company which is currently traded at around 826 crore market cap. So, to give you a brief overview about the company, this company is an India based integrated manufacturer of tractors and pick and carry cranes. So, the company was started in 1994 and it also manufactures other farm equipments as well. So if you look at the business mix of the company in the last fiscal year 2025, 58% of the company's overall revenue was contributed by the company's cranes division, and 36% is contributed by tractors manufacturing, and a very small portion is contributed by the company's in-house NBFC's division. So the key investment thesis for the company, if you look at right now, so the company is undergoing capacity ramp up in its cranes division, which could act as a key growth driver for the company's future. The tractors business, the company which is operating right now, is highly competitive in India currently. We have big players like Mahindra and Mahindra who occupies majority of the market share, and it's very highly competitive in nature. So the company has recently strategically shifting away their focus from tractors to pick and carry crane sector, which is basically a very niche segment, and there are not many global players in this segment. So the company's production facility can currently manufacture roughly around 1,280 cranes, and with this capacity expansion, they're increasing by 3,600 units annually, taking the total installed capacity at 4,880 cranes per annum. So this can lead to better sales realization and profitability. This could be a key growth driver for the company in the future. And along with that, from the IPO proceeds, the company utilized roughly around 60 crores to repay the existing debt, which led to the decline in the debt to equity ratio from 0.9 times to 0.3x in the latest fiscal. So along with the operational profitability from the ramp up of the cranes division, the company's overall return capital employed, we expect to increase from 3% in the last fiscal to roughly around 5% in the future. So here's the brief overview of the company's business. As we already discussed, the company has three main divisions, which is cranes manufacturing, tractors manufacturing, and NBFC. So in the cranes manufacturing division, the company manufactures pick and carry hydraulic mobile cranes ranging from 9 tons to 30 tons capacity. So the current production facility can manufacture up to 1,280 cranes per annum, and with the current capacity expansion which is going on, 3,600 more additional units is going to be operationally online by fiscal year 2026. So the sales from the cranes division had grown at 31% CAGR in the last 5 years, and with this enhanced capacity, we expect the sales division to grow at 24% CAGR in the next 5 years. So this is about the cranes division. Coming to the tractors segment, the company started operations with only a single model of 50 horsepower, and currently now it's manufactured from a range of 16 to 110 horsepower. So the company had installed a capacity to manufacture 12,000 tractors per annum, but it's operating at only 12% capacity utilization in the last fiscal year, which offers a huge headroom for improvement. And coming to the last division, which is Baroda Finance, is nothing but a wholly owned NBFC subsidiary of the company, which is into financing the tractors and other equipments the company is manufacturing. In this NBFC segment of the company is currently managing 140 crores of overall assets under management, and they have 6,000 active customers as of fiscal year 2025. So to give you a brief overview of the industry, the construction equipment market in India is currently valued at $14.3 billion US, and it's expected to grow at 7.6% in the next 5 years. So the earth moving equipment dominates the market with 72% market share, while the material handling equipment, in which the Indofarm equipment is part of the cranes division, it accounts for roughly 14% of the overall construction equipment market in India. So the key growth drivers for the segment is government initiatives like National Infrastructure Pipeline and Gati Shakti program. So that's about construction equipment sector. Moving on to the agricultural machinery market, it's currently valued at $16.7 billion in 2024 and expected to grow by 8.5 CAGR over the next 5 years. Tractors dominate this sector with a market share of roughly 86%. The key growth drivers are improving mechanization, government initiatives, and need for enhanced productivity in agriculture. And if you look at the tractors loan book, the overall AUM in India is roughly around $12 billion US, and it's projected to grow by 12% CAGR in the next 4 years. Moving on to the financial analysis. So the sales of Indofarm has been growing at 10% CAGR in the last 5 years, and we expect the sales to grow at 17% CAGR in the next 4 years. So the capacity ramp up in the cranes division could act as a key growth driver, leading to better sales realization and profitability. The cranes business proves to be a slightly higher margin business than the tractors division. In FY25, the average selling price of a pick and carry crane was roughly around 19 lakhs, and the company sold 1,184 units at 93% capacity utilization. So with the given capacity ramp up, this division could act as a key growth driver, leading to better sales realization and profitability. Raw material consumption is the key cost for the company, roughly around 60%, and employee benefit expense is another 12%. So this lead to an operating margin of roughly 12%, and we expect this trend to continue in the future. The net profit margin has improved from 3% in fiscal year 21 to roughly around 6% in the last fiscal year, aided by better operational and financial leverage. So we expect the earnings per share to grow at 12% CAGR over the next 3 years. So the ramped up production capacity, declining leverage, and improved growth prospects underpin a favorable midterm outlook for the company in the future. If you look at the company's operations, the manufacturing is deeply backward integrated. The company has 127,000 square meters of manufacturing facility, which is located in Badi, Himachal Pradesh. So this includes a captive foundry unit and dedicated machine shop, fabrication and assembling units for tractors, pick and carry cranes and other equipments. So the company produces 40% of tractors and 60% of the crane components by value internally. The operations are deeply backward integrated to improve efficiency. The company has utilized around roughly 60 crores of the IPO proceeds to repay the existing debt. So with the declining leverage and improved operational profitability from the ramp up of pick and carry crane division, the company's overall ROCE we expect it to improve by 200 basis points from 3% to 5% by FY27. So the company is currently led by Mr. Ranbir Singh Kadwalia, who is the Chief Managing Director and have 3 decades of experience with the company. Previously, he had worked at Eicher Group, and the company also has a strong senior management with experience in manufacturing of tower cranes, aiming to strengthen the operational capabilities and drive growth in this specialized sector. If you look at our valuation overview, we had assumed a 12% cost of capital and a 6% long-term growth rate to discount the future free cash flows of the company to arrive at a discounted cash flow valuation of 225 rupees per share, which offers a comfortable 30% upside from the current market levels of 172 rupees. And going by the trading comparables methodology, the heavy machinery and equipment industry is traded at 32 times FY26 price to earnings multiples, and we expect the Indofarm's earnings per share to grow to 6.4 rupees per share, which gives us an intrinsic share price of 206 rupees, which also again offers a comfortable 20% upside from the current levels. So we use a weighted average methodology. We give 90% weight to DCF and 10% to traded comps to arrive at a weighted average share price of 224 rupees, which still offers a decent upside from the current market levels. The key risks to our investment thesis include an elongated working capital cycle of the company, which stood at 318 days in fiscal year 2025, which is mainly attributed to the inventory holding period, as the company has to maintain adequate inventory to meet a surge in demand linked to harvest time. So the company also faces stiff competition, same in the tractors division, from the likes of Mahindra and Mahindra and Farm Equipment Limited. So given the risks and the valuation, I think the company still offers a decent upside from the current market levels, as the capacity ramp up, decline leverage and improved profitability could act as key drivers for the company's growth in the future. I hope you found the investment thesis insightful. I'll catch you with another interesting company. Bye-bye.